Hey guys, what's up? It's Derm here at Derm Talks. Hope you're doing well. So today we're going to talk about Phil Town's big five numbers, and these are talked about in his rule number one investing book, and they're five key ratios that probably changed my whole view on what I look for in trying to find wonderful companies at wonderful prices. So without further ado, let's go and take a look. Okay, so what are the five ratios? And they're basically in order of importance. You've got number one, which is return on invested capital, and then the following four are known as the growth rates. And the first one is called your equity book value per share. The second one is the earnings per share. The third one is called sales growth rate, and the last one is called cash flow growth rate. Now, the four that I've just mentioned, basically you should look at the actual percentage increases over time rather than the actual raw numbers, because that is where we actually want to see the growth, hence the reason why they're called the growth rate ratios. And basically Phil tells us to look at these ratios over a 10-year, a 3-year and a 1-year average, and that is because we want to make sure that the company that we're looking at has got a wide established moat. That means that it can keep its competitive advantage within the market and command these high returns that is seen on the ratios, and therefore it is still a wonderful company that is going to continue to be a wonderful company in the future. So starting with number one, return on invested capital. This basically looks to measure how effectively a company is using its money in its operations to get money back out via profits. It's a very good indicator as to how well companies are allocating capital, which as shareholders we want them to maximize this so that we then maximize our returns through the share price, and therefore because the company will be valued more. And the way that we actually work out this formula is by taking net operating profit after tax, which is normally found at the bottom of the P&L, and then we divide that by equity plus debt, which you can see the formula above. Now, so if we take a quick example, say if we actually invest £200 into setting up a lemonade stand, and our profit at the end of the week is actually £100. Basically, the return on invested capital is 50%, which is quite good. It's better than actually probably investing into a savings account, which is only going to give you like 0.5%. So number two in the list is the equity growth rate, and this is basically number one out of the four out of the growth rates, because it looks at if a company just had enough one day and they just wanted to understand what their business was worth after they got rid of all the liabilities and paid everyone up. This ratio basically tells them per share how much that their business is worth. So the way to calculate it is that you take your total assets minus your total liabilities, gives you your equity, and then you divide that by the number of shares in your company, and then that gives you a book value per share. So the reason why we're interested in it as a growth rate is because we don't want to look at the raw numbers, because it doesn't really give us that much information, and different services or different sectors will actually have very different book values per share. Because say if you take a service industry, they actually need a lot less assets to generate income compared to say a railroad company. So if we take an example, say if our assets are basically 100,000 and our liabilities are 20,000, then our total equity would be 80,000. And if we had 2,000 shares, then our book value per share would be $40. So number three is basically the earnings per share. Now, I don't think this really needs much introduction because you guys will have seen it, and it's probably one of the most used indicators. And it basically shows you how much the business is making in profit per share, and therefore giving that return back to shareholders or the company. So it's known as the bottom line because it tends to be right at the bottom of the income statement or the P&L, and most companies will report it on a basic and a diluted earnings per share. So if we take an example, say if we actually made 100,000 profit for the year, and we've got the 2,000 shares as discussed previously, then our earnings per share is $5. So again, growth rate, So it's about the actual increase over time, over 10 years, 3 year, and 1 year, rather than the actual raw numbers. Number four is the sales growth rate, and again, this basically looks it's a top line revenue figure, and we just want to make sure that the company that we're looking at is a wonderful company because its sales are consistently growing and at a good level, and that just basically means that the products and services it sells are still relevant to the customer or consumer, and they're still in demand. So obviously that just means it's a good sign of it having a good wide moat, and it's still relevant in today's market. So a simple example would be, say, if we made $300 in year 1, and then in year 2 we actually made $1,000, then the increase would be 233%. And the way that we calculate that is we take the difference between year 1 and year 2, which is $700, and we divide that by year 1, and therefore we get the 233%, as you can see here. So hope that made sense, and let's move on to the next one. So the last and final one, number 5, is the cash flow growth rate. And this basically is, as the name suggests, it's a growth rate. So we're going to track the operating cash flow that can be found in the cash flow statement, and we would just want to look at the percentage increases or decreases over that 10-year, 3-year, and 1-year average, as Phil Town suggests. Now, in a wonderful company, they should be consistently growing on a year-on-year basis, and we should be seeing at least some good, strong averages across the years, which will suggest that it's a wonderful company. Now, it's also useful in helping us to identify value trap companies. Now, value trap companies are basically companies where, as long as investors are getting their dividends, they think that everything is okay, but in reality, to get paid them dividends, the company has to go on out and get finance, which increases the leverage and increases the risk of the company going belly up, I suppose. Now, obviously, cash does not lie, so that is the reason why, if you take a look at cash flow from operating activities, you will be able to see how much of the percentage of the dividend payment is of the free cash flow, and therefore how much of a risk is that to the company going forward. Hopefully it should be a small percentage, and therefore it's not really a risk. But if you've done all the other 5 ratios and they're looking good, the chances of this being a value trap company are probably very slim. So, but it's still a good one to have a look at. Leave a comment below. Let me know if there's any other key ratios that you find helpful, or that you particularly look at when analysing a company. So let's go back. So guys, if you actually enjoyed this video, then please don't forget to like and subscribe below. And also, if it's wanted to make you start investing, then follow the link that I've left down below for Trading 212. And once you sign up and you can deposit as little as £1, you will get a free share. I will also get a free share, and half of that share of mine will go to charity. So what a perfect weekend for you. You've learned something new, you started investing, and you've given back. So head there straight away, and I'll see you on the other side. Catch you later, guys. Bye.